Okay, good afternoon, everybody. Thank you for joining this InvestEngine webinar, which is all about pension tax relief. I'm Andy Prosser. I'm the head of investments at InvestEngine, and I'm joined today by Charlotte Baroukh, who's a tax consultant at Pi, the self-assessment app. Now, in terms of the plan for the webinar, Charlotte and I are going to be going through a quick presentation, which we're hoping should cover off everything that you need to know about pensions and tax. So we're going to be talking about things like what a SIPP is, why you might want one, and how you can use them to invest really tax efficiently. There is going to be a Q&A section at the end. So if you do want to ask questions as we're going through the webinar, you can click on the Q&A button at the bottom of your screen. The questions aren't going to be broadcast to the whole webinar chat. They're just going to come straight to us. So don't worry if you think you've got a stupid question. That's absolutely fine. Just feel free to ask away, and we'll answer as many as we can at the end of the webinar. It's my job to make sure that everything runs on time. So I need to make sure that I leave enough time at the end for the Q&A. So I'm hoping that this presentation should last about half an hour, maybe 35 minutes, and then 10 minutes-ish at the end for Q&A. So the plan is to end the webinar at about 5:40 to 5:45. Now, with that, before we get stuck into the presentation, Charlotte, maybe you can kick us off by giving us a quick intro into who you are and who Pi are for those who might not be familiar.
Yes, hi everyone. So as Andy said, I'm Charlotte, I'm from Pi, and Pi is a new self-assessment app which has just recently launched, and it essentially enables you to complete and submit your self-assessment tax returns and send them directly straight to HMRC. And alongside doing that, we also help and give you lots of tips and tricks along the way. So I am going to accompany Andy today and talk to you about the different tax reliefs that you can get through contributing to a pension.
Lovely, thank you very much. Let's get going then. But just before we do get going, I do need to mention the usual disclaimer that your capital is at risk whenever you invest. This webinar is for UK clients only, and that none of this is financial or tax advice. Okay, next slide, please. First slide, please. Here we go. So starting with the basics then. There are two main kinds of pension that we really need to be aware of. There's a net pay pension and there's a relief at source pension. So net pay is where your pension contributions are made before you pay tax. So they're paid from your gross salary before tax. And that's how most employer pension schemes work. So the chances are that if you're employed, then your employer will be making contributions into your pension on a net pay basis. The one big exception to that rule, and I think I listed it on the slide there, is the NEST employer pension scheme, which is a really popular pension scheme, particularly with smaller employers. And they use this second method, which is called relief at source. But most employers are net pay. So relief at source means that the contributions that you make to your pension are after you've already paid tax. Again, there are some workplace schemes like Nest that use this method, but importantly, all personal pensions are relief at source. So, for example, because you make your contributions to your SIPP after you've already paid tax on it, i.e. because it's from your bank account after you paid your income tax, that's relief at source. And a really easy way to tell if you're looking at your kind of employer pension, whether your employer is using net pay or relief at source, is just to look at your payslip. If your pension contributions are being made before tax is paid, then it's a net pay scheme. If they're being made after tax has been deducted, then it's a relief at source. And as I said, all personal pension contributions will be relief at source. So we're going to be focusing on the second one, this relief at source pension, for the majority of the webinar, because there are a few tips and tricks that everybody who pays into a relief at source pension should know about. And with that, I'm just going to clear up one potential bit of jargony bit on the next slide, which is all about SIPPs and what a SIPP is, because we're going to be using the word SIPP quite a lot in the webinar. So just want to make sure that we're all starting from the same place in case anybody's not familiar with what a SIPP is. Essentially, it's a type of personal pension, which means that it's not tied to your employer. So you can open a SIPP yourself, and you can make contributions whenever you like and for however much you like. They're very flexible. They're different from traditional personal pensions because they offer a much broader range of investment options, and really just give you kind of more control over your investments. So anecdotally, I know a lot of people who use SIPPs because either they're self-employed, so they don't actually have access to a company pension scheme, so they have to use a SIPP, or maybe they are employed, but their employer pension scheme just isn't very good. So maybe it offers like a really limited selection of funds, or it only offers really expensive funds, or the platform's really bad. So what they do in that case is obviously make sure they get their maximum match from their employer. And that means they should always kind of contribute enough to the workplace pension scheme to max out the employer match. But then they open their own SIPP on the side, and make extra pension contributions above the employer contribution through that, because it gives them access to better funds and better platforms. Now, I say that you do it yourself. You can do it yourself with a SIPP. It's kind of in the name, self-invested. But when you open a SIPP, you can still have someone manage your portfolio for you if you'd like. You can open a SIPP on the InvestEngine platform, for example, and you can either choose to pick your own ETFs and create your own portfolio, or if you'd rather have our investment team manage the portfolio for you, then you can opt for a fully managed portfolio. And what that means is that we'll build a portfolio based on your answers to a short questionnaire, and then we'll do all the rebalancing, all the risk monitoring, all the portfolio changes for you. So the key thing there is that you can either build your own portfolio in a SIPP, or you can have it managed on your behalf. In terms of accessibility, you can access your SIPP. At the moment, it's age 55. But that's raising to 57 in 2028. So usually the rule here with personal pensions is that you can access them 10 years before the state retirement age, or state pension age, which is rising to 67 in 2028. So hopefully that should cover off the absolute basics, and lay the groundwork for what is to come. But now we're going to get onto the really interesting bit, which Charlotte is going to take us through, and that is how SIPPs and tax relief work.
Yes, sorry, I've just had to keep muting it because I keep getting an echo in my end. But yes, as Andy said, so one of the most important reasons why people contribute to their pensions is because of the tax relief associated with it. So this slide kind of sets out the different tax relief for the different tax brackets. So if we start with basic tax relief, so when you invest into a SIPP, HMRC will give you an uplift of 20%. Automatically. Well, the pension provider claims it, but they will always give you this 20%. So let's say you wanted to have a pension contribution of £10,000. You would personally have to contribute £8,000, and then HMRC would top it up the additional £2,000 to bring you to your £10,000 gross contribution. So that's what happens if you are a basic rate taxpayer. Now, moving on to if you're a higher rate taxpayer, so this is if your annual income is over £50,270, on the amount that is higher than that threshold, you can claim additional tax relief of 20%, and you have to do this through your self-assessment tax return. And then this is actually the same if you're an additional rate taxpayer, but the additional tax relief of 20% is increased to 25% to give you an overall tax relief of 45%. And actually, just to note that once you've received this additional tax relief, if you're a higher or additional rate taxpayer, you can choose to contribute this relief into your pension as long as you are still within your annual allowance. Next slide, please. So just a few notes about the limits of the pension tax relief. So as I just kind of briefly mentioned, the annual allowance for most people is £60,000 a year, and this is gross. So this is not just the amount you contribute, but the amount that the employer, if it's a workplace pension, or HMRC contributes. It's the gross amount. It cannot exceed £60,000. However, if you are on a lower income, so if you earn below £3,600 a year, your annual allowance is capped at this £3,600. Even if you don't earn anything, you have an allowance of £3,600. And then if you are a much higher rate, if you have a really high income of over £260,000, this annual allowance is reduced by £1 for every £2 you earn over this amount. And the minimum annual allowance that you would have in this scenario is £10,000. You cannot contribute more than your annual income. So let's say that you earn £40,000 a year. That is your limit. You cannot contribute £60,000, even if you have savings as well. It's completely based on your annual income if you earn below that £60,000. And then the point below about the extra tax relief, I talked about in the previous slide, but it's only the amount over the higher rate tax band of £50,270 where you can start claiming that additional relief.
Yeah, so I think we've got a couple of examples to come out. I'm sure that sounds a bit gobbledygooky and messy for a lot of people listening, but that's totally fine. We've got some nice, straightforward examples, which we can talk you through here. So starting with the first example here, keeping it very simple, we've got a basic rate taxpayer earning £30,000 a year. They pay in £8,000 to their SIPP. The government tops it up by £2,000. And I actually saw a question in chat from somebody asking, wait, isn't it a 25% uplift rather than a 20% uplift? It's 20% of the gross amount, 25% of the net amount. So yes, it works out as 25% of 8,000, but it's 20% of the total, which is 10,000. And the government will pay that into the £2,000 into your pension pot, meaning that the total increase in pension is £10,000. It's all done automatically by the pension provider, so nothing that they need to do to reclaim because they're not a higher rate taxpayer. So if we go on to the next slide, we've got a nice little picture to demonstrate. We've got £8,000 in contributions. We've got £2,000 from the government, no higher rate relief. So the total increase in the pension value is £10,000. Hopefully that's all pretty straightforward and everyone's still with me. The next example, the salary goes up a bit. So this person earns £70,000. So they're now in the higher rate tax bracket. Let's say that they pay the same contribution as in the last example, which was £8,000. They get the same top up from the government, which is £2,000. But because a SIPP is a relief at source pension, i.e. the contributions are made after tax has already been paid, they can claim back an additional 20%, which is another £2,000 from HMRC. And as Charlotte was saying before, they can then decide what they want to do with that £2,000 because it's reimbursed to them rather than being added to the pension pot. So they can either choose to keep it in cash, or if they want to, they can invest it into their pension and get all of these tax benefits again. So if we go to the next slide, we've got a nice little waterfall chart here showing that, here we go, it's the same £8,000 contribution. We have the same £2,000 top up from the government, but because they're a higher rate taxpayer, they can also reclaim another £2,000 from HMRC, bringing the total increase in pension value to £12,000 from just an 8K contribution. So that's pretty good. That's a 50% return right there, just from tax benefits of investing through your SIPP. Slide three, example three, sorry. Just a kind of slight nuance here. This person, again, same person earning £70,000 a year, same as the last example, but wants to contribute a little bit more to their pension. So before the contribution was £8,000, we've now upped that to £25,000. And that means they obviously get a bigger government top up of £6,250 because the contribution's bigger. But the key point to note here is that when they reclaim that higher rate tax, they can only reclaim the 20% on the £20,000 that they've earned over the £50,270 higher rate tax bracket limit. So even though they contribute £25,000, they only get that higher rate relief on £20,000, which works out at 20% of 20K, so just under £4,000 from HMRC. So still very worth doing, but just a slight point to note there on how much you can expect to reclaim from HMRC if you earn over 50K. And here we see the 25K contribution. If we slip onto the next slide. Yeah, got the 25K contribution there. Very nice. The 6,250 top up from the government. And then this time the reclaimed tax isn't the same as the government top up, which it was in the last example. It's a bit smaller because you only get that nice 20% relief on your earnings over £50,270, which in this case works out at just under 4K. So hopefully that's all well and good. Hopefully we've made the key point here that if you're a higher rate taxpayer and you're paying into a relief at source pension, which is all personal pensions and some workplace pensions like Nest, then you can and you should be reclaiming tax from HMRC. I know the maths can seem a bit confusing, but to help make it clearer, we've got a pension tax relief calculator on our website, which has just gone live today. And we're going to include a link in the follow-up email to everyone who's on this webinar now. And what you can do with that is you can just input what your income is and how much you're contributing into your pension, and it will work out what the government top-up should be and how much you can reclaim back from HMRC. Now, with that in mind, I am going to hand over to Charlotte now to tell you how you can actually go about claiming this tax back from HMRC. Over to you.
So I just want to touch on that actually, and I've seen a few questions coming in asking if you can backdate these claims. And yes, you can. You can backdate them up to 4 years. So if you didn't know about the additional tax relief, if you've never submitted a self-assessment before, you can absolutely backdate this the reliefs for 4 years. So do not worry about that. You will be able to get your tax relief. So moving on to ways that Pi can help you. So Pi can obviously help you keep account of your pension contributions and help you claim this tax relief. So from April 2025, the pension contribution tax relief will be fully integrated within the app. But in the meantime, before this has officially been launched, our tax consultants can claim the additional tax relief for you for free on your behalf, which will obviously save you a lot of time. Other ways that Pi as an app can help you with your pension contributions is this tapered annual allowance that we just discussed earlier. The tapered annual allowance is when you earn over £260,000 and the £60,000 allowance gradually decreases. So the app will automatically calculate it for you. So obviously it will be aware of your different streams of income. It will be aware of your total annual income, and therefore will be able to let you know what your annual allowance is for that year, which will be super helpful for you. And then also monthly insights is something that we really pride ourselves on. So we're really trying to help people find tax efficient ways to save for the future, save for their retirement, keep talking about pensions to remind people that pension contributions are so important to be prepared for your future. So that is really handy as well. Next slide, please. So other ways that Pi can help investors. So alongside pension tax relief that we have just discussed, there are many other different types of reliefs that that can apply to many investors. So CGT exemptions and just optimizing the way that you use your money, again, to save for the future and be prepared. In terms of self-assessment, so the high rate pension tax relief obviously will be fully integrated. So you'll be able to use that to do all of your calculations and submit timely tax filings. A really important and useful feature of the app is real-time insights. So alongside your pension calculator, which is super handy, we also have a free tax calculator. So you'll be able to kind of jot all your figures in and figure out roughly how much you'll have to pay that year, as well as getting a real-time tax position. So if you update the app and if you fill it out with all your income and expenses throughout the year, you'll get a real-time tax position, which is really important to know how much money to put away to make sure that you have that money ready to go by the end of January when you file your self-assessment. And then final point, compliance made easy. We will do the tracking ourselves of all of the reliefs and the allowances available to you. Make sure you don't miss any deadlines. And yeah, just keep on top of regulations. So moving along to maximising investment. So we discussed the SIPP reliefs, but actually I must note that you can carry forward unused allowances for the past 3 tax years, which is a really good point to note and a good tip, because if you feel like you haven't paid as much in prior years and you want to catch up, you absolutely can. So that's a good point to note. And then also diversifying investment with tax wrappers. So you can combine your SIPP with ISAs and EIS and SEIS schemes. So just a brief overview of these schemes. An ISA is a completely tax-free way of growing money. You have a limit of £20,000 a year, and all of the interest, if you have a cash ISA, all the interest you earn or all of the growth on your stocks and shares ISA is completely tax-free. It's a really, really good way to invest your money. EIS, SEIS, I can talk about later if you're interested, but it's other really tax efficient ways of investing. You can get capital gains tax relief, income tax relief. It's really important to know what's available to you. And then these points below, we've kind of covered already, just planning ahead for retirement, making sure you're prepared and you're making your money work for you. Okay, so these are my top tips of how to maximize your pension contributions. The first tip I've already covered, carry forward unused allowances. That's just a really good tip to know. A lot of people don't know that, so just good to make people aware. Now, the next tip, save half your age. I don't know if you've heard about this before, but it's a really good school of thought that the age that you start your pension determines how much money you put into your pension, although of course you can put more in if you want to. But let's say you open your pension and you start contributing to your pension at the age of 20. You should ideally be putting away 10% of your income or contributing 10% of your income every year from that moment into your pension to have a good retirement pot. And if you then decide, so that's if you decide to start at 20. If you decide to start at 40, that half your age is 20%. So then from that moment on, you should be aiming to put away 20% of your earnings, contributing 20% of your earnings every year to get a good pot for retirement. And also you can make contributions on behalf of your spouse, as long as you both still remain within the annual allowance. Over to you, Andy.
Yes, this one's for me. Right, thank you, Charlotte. Before I get into this slide, though, please do keep your questions coming in. I can see there's lots coming in already, but this is the last slide before the Q&A section. So we'll answer as many as we can in a second. Do keep them coming. Right, impact of fees. Okay, this is a graph which shows the growth of a fictional pension portfolio over 40 years. Now, it assumes, as we've been talking about all webinar, that this person is a higher rate taxpayer and they contribute £400 a month into their pension. And the best way to start looking at this graph, I think, in terms of how instructive it is to look at the blue line. And the blue line shows how those contributions, plus the government top up and plus the reclaimed tax, would grow if the investor paid no fees on their investments and had 7% returns a year. So a really nice kind of idyllic best case scenario. All those £400 per month would eventually grow into a portfolio worth over 1.5 million over 40 years. And even by itself, I think that's quite a powerful stat. You know, £400 a month is still a lot of money to put aside each month, but it should be possible for a lot of people, especially if you're a higher rate taxpayer. And the chart shows that from a relatively modest £400 a month over time, and with the benefit of those government top-ups and those reclaimed tax reimbursements, that those £400 can grow into a really significant pot of money. Now, if we go one line down to the green line, that shows the impact of fees. If they instead paid a 1% fee, that 1.5, 1.6 million-ish would shrink to just over 1.2 million. So they're losing 300K basically from paying that 1% fee. And that really just highlights the kind of destructive power of fees and really making sure that you pay attention to fees when you're thinking about your investments. The next line down is the pink line. And that shows what would happen if this person failed to reclaim the higher rate tax, which I think is a position that a lot of people are in. So if you didn't reclaim the extra 20% from the government, then your pot would now be worth under £1 million. So 600K-ish lost in fees and unreclaimed tax. The bottom line, the grey one, shows what would happen if you didn't put those £400 into a pension, but instead put them into an ISA or into a GIA, which don't have the same government top-up or the ability to reclaim the tax back. So in that case, your £400 a month would grow to only 760K, about half the kind of best case scenario. So really, there are kind of 3 points to take away from this graph. One, make sure you pay attention to fees because they can significantly reduce the value of your portfolio over time. Second one, make sure you remember to reclaim the tax from HMRC, the higher rate tax from HMRC, if you're contributing to a relief at source pension. And number 3, if you don't need the cash until retirement, make sure you stick it into your pension so you can get those great tax benefits that we've been talking about. Right, and with that, that just about wraps up the main part of the presentation. We've finished a few minutes early. We do now have a bit of time to go through some questions, and I can see that we've got a healthy number of questions coming through. So let me just have a skim through the Q&A and see if we can pick a nice one to get us started with. Right, okay, probably a good place to start because it's something you mentioned earlier, Charlotte. We've got a question here on like other kinds of tax relief. So we've also talked a lot about SIPPs and how to reclaim the higher rate tax, additional rate tax, all about pension relief. But what other kinds of tax relief can investors take advantage of for their investments?
Okay, so that's a really good question. So in terms of investing, I always recommend finding EIS companies or SEIS. So that's enterprise investment schemes or seed enterprise investment schemes. So they are startups. If I just focus on EIS. So EIS is a more established startup that's been running for less than 7 years. And essentially, if an investor invests in one of these companies, but there is a limit of £1 million a year that they can invest, they can get 30% income tax relief on their investment. So whatever their investment is, they can offset their tax liability by 30% of that amount, which is just a huge incentive for them. For SEIS, this is actually 50%. And then also they can have capital gains tax exemptions if they've been holding these shares for more than 3 years, and also deferral reliefs. There's a whole host that us at Pi, we can help you. We can help kind of guide you with what might work best for your situation. ISAs I've already spoken about, but for investors, I always focus on EIS and SEIS investments.
Very good, very comprehensive, thank you. There is a question here, which I can see has been asked quite a few times in the Q&A. So I will do my best to answer it. And all the kind of questions have a kind of similar bent, which is about having SIPPs alongside company pensions. So the question is really, can I have a SIPP alongside a company pension? And the answer is very much yes. In fact, a lot of people will max out their employer match for their workplace pension if it's a defined contribution pension, and then they'll open a SIPP as well, so that if they want to make additional contributions, then they can do that via the SIPP rather than the company pension. And really, that's for the reasons that I was talking about before, because a lot of workplace pensions offer quite a poor selection of funds. Either there's not very many of them, so there's not a lot of choice, or the funds simply aren't very good funds, or they're really expensive, or the pension itself is really expensive. I know Nest take 1.8% of all your contributions before you even invest. So what a lot of people do is kind of a very popular thing, if you don't have a great workplace pension, is to open a SIPP alongside. And then for all the contributions that you want to make over and above what your employer will match for your employer scheme, you make those into your SIPP, because then you get the advantages of having access to all of the SIPP platforms available, of which one is InvestEngine. So you can have all those good low fees and the broader choice and the better platform from a kind of non-workplace scheme if you open a SIPP. So yes, definitely possible to have both. And a related question, I've just seen one come in about SIPPs and how many can you have? You can have as many as you like, but you should keep in mind, I guess the thing to bear in mind here is the annual £60,000 limit, which Charlotte mentioned was gross. So if you do the maths on that, I think it's 48,000 that you need to contribute into your SIPP, and the government will top up the rest to take you up to 60,000. So to max out your SIPP limit, you only really need to contribute 48,000 because that extra 20% that comes from the government will take you up to the £60,000 limit. Because you can't breach that, you can't contribute any more than £60,000, no matter how many SIPPs you have. I guess the flip side of that is you don't want too many SIPPs because then it becomes a bit of an administrative nightmare to keep track of how much you're contributing to which SIPP and how much of tax from which pension pot you've reclaimed from HMRC. But yes, in theory, you can have as many as you want. Right, let's.
Andy, I've just seen a question asking about Pi. The person's asked, does the Pi app support people who are both employed and self-employed? And just a really quick, simple answer is absolutely yes. So you can have multiple income streams on the app, which, to be honest, is one of the things that sets it apart from competitors. So yes, you can absolutely have your employed and self-employed streams all together to make it easy and simple for you.
Very good. Thank you very much. Lots and lots of questions about whether a recording of this is going to be made available. That's a nice, easy one because the answer is yes. This whole presentation is going to get uploaded to YouTube. And then we're going to send a follow-up email afterwards, which includes the links to the YouTube channel and the YouTube video, as well as the pension calculator, link to Pi, and I'm sure some links to some helpful kind of SIPP FAQs that we have on our website as well to help everybody out there. So that answers that one. I saw this was quite early on in the webinar, but somebody did ask, I'm struggling to find it now because there's been so many questions coming through, but there was a question on migrating pensions, and specifically migrating pensions from Vanguard. And this question, I guess, is being asked because Vanguard have recently raised their fees. So for those who don't know, Vanguard recently hiked their fees. So there's now a £4 a month minimum fee, which has caused a bit of a stir among investors and caused a lot of people to look for alternatives. So to answer the question, yes. In short, it is possible to transfer from Vanguard to InvestEngine if you would like to. If you do want to do that, it's super simple. You go into the app, create a SIPP, and then in the options menu, you just click the transfer a pension button, and the rest should be pretty straightforward. There's a little form to fill in, and then we'll kind of handle the whole transfer process for you. But just to note on that, Vanguard are currently the only provider that we're able to accept transfers on. Obviously, you can still open a SIPP on InvestEngine and start contributing to it. But in terms of transferring an existing pension, we only accept them from Vanguard. Obviously, we're working really hard to accept transfers from as many other providers as possible, especially given how much demand we're seeing from people transferring from Vanguard. But at the moment, it's only from Vanguard. Okay.
I can see a question, but it's actually not a pension related question. Someone has asked if, like the pension tax relief, if the ISA £20,000 a year limit is also stackable over 3 years. Unfortunately not. You have £20,000 a year, and if you don't use it, you lose it. So yes, you cannot do £30,000 one year, £10,000 the next year. It's limited to £20,000 a year.
Very good. Question here, probably for you, I think. How quick is it getting the higher rate tax? Actually, I can combine two questions that have come quite close together. How quick is it getting the higher rate tax relief kind of back? Is it weeks? Is it months? And how does that reclaimed tax work? Is it a lump sum bank transfer? Is it through an adjustment to your tax code? How does that work?
So the easiest way to reclaim this is through your self-assessment. So obviously that's whenever you choose to do that in the year, that's when you should claim it. And they say 8 weeks. They say 8 weeks. So, we hope 8 weeks, and then it does get transferred back to you, and then you can re-contribute it if you choose to.
Lovely. Right, while you're giving that answer, I was just scanning for another question to answer, and we have a question on the tax trap. And this is the 100K tax trap, which I don't think is particularly well understood, which I guess is why somebody has asked the question. So hopefully I can clarify things a little bit. And the crux of this question is really about people that earn between 100 and 125K. And in that scenario, your effective rate of tax on whatever you earn over 100K is effectively taxed at 60%, 60. And that's because not only are you a higher rate taxpayer, so anything that you earn over 50K is taxed at 40%, you're also gradually losing your tax-free personal allowance, which is usually £12,570. But that shrinks for every £2 that you earn over 100K. So it shrinks by £1 for every £2 you earn over 100K. So what that means is that by the time you earn 125K, you've got no personal allowance left because it reduces in a kind of linear fashion from 100 to 125K. So that means that anything that you earn between 100 and 125K is effectively taxed at 60%, 40% from income tax, and the additional effect of gradually losing your tax-free personal allowance. So what a lot of people do who are in this situation to avoid the tax trap is to do exactly what we've just been talking about, contribute to their personal pension. If you contribute enough to your pension that you keep your taxable earnings below 100K, then you avoid this whole 60% marginal rate of tax problem entirely. So, for example, let's say you're earning 110K, you're effectively being taxed at 60% on that 10K. But if you contribute that 10,000 into your pension, then you reduce your taxable earnings to 100K, which means your income is now only being taxed at 40%, and the extra 10K has gone into your pension. And if you reclaim the higher rate tax relief, then it's gone to your pension tax-free. So that's a really tax efficient way to invest, and hopefully that clarifies things a little bit.
I've just also seen a few questions about how and when to fill out your self-assessment tax return form. Really good question, but it needs to be sent in by the end of the month. The deadline is the 31st of January. So really try and make that deadline to avoid any fines and penalties.
Yeah, and I can do another quick answer. Someone's asked, anonymous attendee has asked, can I claim back the tax relief from contributions to Nest? Yes, that is, as we were talking about before, Nest is a relief at source pension, so you can and very much should be claiming back any higher rate tax relief from HMRC, as well as your SIPP. The company pension, it says Nest/company pension. If your company pension is not relief at source, then you can't. If it's net pay, then that's fine. You don't need to worry about it. It's only if your company pension is a relief at source pension, which Nest is. Question on fees. Right, I'll cover off InvestEngine fees, and then Charlotte, you can do Pi fees. Good question. Someone was obviously paying attention to that fees chart before, and I always like answering this one. From InvestEngine side, no fees for a DIY portfolio, no trading fees, no account fees, no FX fees, and for managed portfolios, if you want us to manage your portfolio for you, as I was talking about before, it's 0.25% per year. Importantly, as we're talking about SIPPs, there is no SIPP fee, which I know a lot of other providers do charge. So that's kind of the summary of InvestEngine's fees. Charlotte, do you want to cover off Pi?
So if you to do your self-assessment tax return yourself, it's completely free. And as I mentioned before, if you need help reclaiming your pension tax relief, we will do that for you for free. But other than that, if you need advice, if you need help, if you want your tax return to be checked before you send it off, that is a fee of £59.99, and if you want us to do it for you, that's £149. But if you're happy to do it yourself, and you're confident doing it yourself, but you just need that help with the pension contribution tax relief, we will happily do that for free before it's fully integrated into the system in April.
Very good. And someone's asked, does the Pi tax applicated for pension relief? And I'm guessing the answer is yes, because that is what we're talking about here.
Yes.
Question about inheritance tax. Inheritance tax and pensions. I know there's been a lot on the news recently about
Yes.
how
Subject.
pensions are going to be treated for inheritance tax. So do you want to take that one, Charlotte?
Yes, absolutely. So previously, pensions were exempt from inheritance tax. The treatment of pensions depended on the age when the person who held the pension died. So if you were under 75 when you died, your pension would be passed on completely tax free. But if you died over 75, your pension, your descendants would have to pay income tax at the marginal rate as they would draw down your pension. Now, well, I say now, as of April 2027, your pension pot will be included in the value of your estate. So if your total estate, including your pension pot, is above the nil rate band threshold of 325,000 or 500,000 if you're including property as well, you will have to pay inheritance tax on that. And then the same rules will apply in terms of income tax with the drawdowns. It will depend on the age, but the key difference is that your pension pot will be included in your inheritance tax estate calculation.
Yeah, that is very clear. Thank you very much. We've got a question, a slightly confusing question on, I guess the question here is about ISAs versus pensions. The question is, if I have a stocks and shares ISA, can I also have a pension ISA? So ISAs and pensions, two different wrappers. The differences are, the main difference, I guess, is how you can access your money if you contribute to one of them. So with an ISA, you have, as Charlotte mentioned, a £20,000 a year allowance. You can stick some cash in there, invest it in a stocks and shares ISA. But if you need that cash at any time, you can sell your stocks and shares or ETFs, whatever you've got in the ISA, and withdraw it. There's no penalty to doing that. But with a pension, what happens is you contribute into your pension, you do all this good stuff, like in the government top up, you reclaim your higher additional rate tax from HMRC. But importantly, you can't access that until the age I was talking about in that slide before. So 55 at the moment, going up to 57 by 2028. So generally, the kind of rule of thumb is that if you know you're not going to need the cash until retirement, then pension is probably a good one to have a look at because you get the good tax benefits and it reduces your taxable income, especially if you're earning between that 100, 125K, but good for all higher rate taxpayers. If you might need the cash a little bit before that, then ISA is probably the way to go. But bear in mind that if you are investing in stocks and shares ISA and you're investing in stocks and shares through your stocks and shares ISA, then your time horizon should be in the kind of 10 years plus, because stocks and shares can go up as well as down, or down as well as up. And the time horizon needs to be sufficiently long so that you have time to recover if the market does fall when you invest. So that's kind of the main difference between the ISA and the pension. They're different tax wrappers, they do different things. So hopefully that clarifies that.
Also,
right.
Stephanie,
we've got 1 minute left. So do you want to take the last one, Charlotte? It sounds like you're
I was just going to say, it's just worth noting as well that when you do come to retirement age and you start withdrawing from your pension, 25% of your pot is tax-free. And that's obviously another essentially relief that you'll be getting up to, it's about just over £268,000. But it's just a good thing to remember that you will be able to take out a lump sum tax-free.
Lovely. Thank you very much. Let's see. Right. Final question. What am I going to go for? Somebody's asking about transferring pensions again. Just to clarify our stance on pension transfers, you can transfer a pension if you have it with Vanguard to InvestEngine. You can't transfer yet if your pension isn't with Vanguard. We're only accepting transfers from Vanguard at the moment. We're obviously working very hard to get lots more pension plans possible to transfer over to InvestEngine, but at the moment it's only Vanguard. You can open a SIPP on InvestEngine, you can transfer from Vanguard, but at the moment that is how you can interact with us and get a SIPP on the InvestEngine platform. We have just hit 5:45. If we haven't answered your question today, There are lots of questions. I've done lots of these webinars before. I'm sure I'm very familiar face with some of you on the webinar now. I've never seen so many questions come through. I've never seen the Q&A box kind of max out at 99 plus questions. It can't even display the full range of questions. So there'll be lots of you whose questions I'm afraid we haven't had time to get to, but we'll try our best to get back to you over the next few days, but there are a lot of questions. You can email support@investengine.com with your questions if it's an urgent question, and we'll get back to you that way. If you want to open a SIPP with InvestEngine, then you can download the app or head to investengine.com, follow those nice big green get started buttons. Please feel free to check out Pi. What's the best way for people to find you, Charlotte? Is it go on the App Store and download the Pi app?
Absolutely. You can also just go online, pi.tax, or email me at charlotte@pi.tax if you've got any kind of specific Pi questions. But yeah, either website or app.
Lovely. I guess all that's left for me to do is say thank you very much, Charlotte, for your time today. I think
Thank
that's
you
a
for having me.
thank you to everybody who's dialed in for joining. I hope you found it useful. And yeah, see you on our next webinar.